Up until the well over 100% gain, on January 6th, FUBO was relatively unknown. So let's briefly go over the catalyst for this incredible bullish jump. Then discuss the background, offerings, and business model of the company, and see how they could contribute to bullish sentiment. Followed by a serious look at some challenges and risks that could potentially counter the stock's continued rise. Now, what really got the market excited on January 6th was when Walt Disney announced plans to merge its Hulu Plus live TV business with FuboTV, the smaller rival, in a move that could create the second biggest online pay TV company in North America. The combined venture would be led by FUBO CEO David Gandler and see Disney hold a 70% majority stake. This deal removes a significant hurdle for Disney's planned sports streaming venture with Fox Corp and Warner Bros. Discovery. As part of the agreement, FUBO asked a U.S. court to dismiss its lawsuit against Venue Sports, the streaming service proposed by Disney, Fox, and Warner Bros. Discovery. Initially, the lawsuit claimed that Venue would violate U.S. antitrust law by reducing competition and increasing prices. In response to a judge's decision to block Venue's launch, the major media companies argued that it would limit consumer choice and result in higher prices for consumers. Now, with that explanation out of the way, let's see what this company is all about. FUBO states their mission is to transcend the industry's current TV model by aggregating the best in TV, including premium sports, news, and entertainment content, through a single app. FUBO is a paid TV replacement product that offers live sporting events, news, and entertainment content through its proprietary technology platform. They aim to aggregate the best TV content globally and provide access to this content via various devices. FUBO believes they can capitalize on the growing cord-cutting movement by offering a superior streaming experience compared to traditional linear TV. They offer subscribers a customizable live TV streaming service with additional features available for purchase, such as enhanced functionality or more content. Their growth strategy mainly concentrates on attracting subscribers who are looking for an alternative to traditional pay TV services and monetizing their audience through subscription fees and digital advertising. This company explains they benefit from the rapid growth of streaming services as consumers prefer their customer experience, competitive pricing, and better value compared to traditional pay TV. Sports and news content have been key drivers for pay TV, but recent developments in streaming allow FUBO to provide a pay TV replacement service with an enhanced live sports and news viewing experience. FUBO's business model aims to acquire subscribers efficiently by leveraging sporting events and then increase retention through their proprietary machine learning recommendations engine. They plan to grow their paid subscriber base, optimize their content portfolio for better engagement, and increase monetization through subscriptions and advertising. Their goal is to drive higher average revenue per user while maintaining a strong focus on sports as well as entertainment content. The main offerings are live TV streaming services catering to sports, news, and entertainment fans with customizable plans and optional attachments like Cloud DVR Plus and Family Share. The base plan, FUBO Pro, includes over 100 plus channels including top-rated networks along with various sports, news, and entertainment options. Subscribers can further personalize their experience by adding premium channels and packages or upgrading attachments for more storage or simultaneous streams. FUBO explains advertisers can leverage their growing and highly engaged audience for effective ad placements. Advertisers are reported to be increasing their ad budget allocations to OTT streaming platforms as cord-cutting continues and traditional pay TV viewers decline. FUBO Sports First, live TV streaming platform is set to provide advertisers with a growing and valuable live audience deeply engaged with premium content unreachable through traditional channels. The company asserts their unskippable ad inventory further maximizes exposure for even higher quality engagement. While their innovative ad formats bridge the gap between traditional pay TV and digital advertising advantages such as measurability, relevancy, and interactivity, delivering a differentiated advertising experience for brands and viewers alike. Similarly, content providers can distribute their content and access valuable consumer insights through the platform, which can make up for the decline in pay TV viewership due to cord cutting. By providing a diverse mix of content, FUBO believes it offers a more compelling and engaging experience for subscribers than individual providers could provide alone. In terms of their growth, FUBO focuses on driving sustainable and profitable growth by efficiently growing their subscriber base through various acquisition channels, expanding ARPU through price increases and attachment sales, investing in advertising sales teams and technology infrastructure for revenue growth, while also continuously enhancing their content portfolio with cost vigilance, and expanding internationally. To aid in these goals, they plan on utilizing the data they collect to improve marketing campaign efficiency and investing in interactive features that empower users to actively participate rather than just passively viewing content. This will become especially important as the TV streaming market remains highly competitive with various players vying for customers, advertisers, and broadcasters. FUBO's primary competitors are pay TV operators such as Comcast, Cox, and Altus, along with vMVPDs like YouTube TV, Hulu Live, and Sling TV. They also face competition from network-operated direct-to-consumer streaming services like Peacock, Paramount Plus, and ESPN Plus. To stay competitive, FUBO states they focus on offering quality content, enhancing user experience, and maintaining a strong brand presence. They also compete for advertisers based on ad effectiveness and return on investment compared to other digital advertising platforms. On a somewhat related topic, FUBO contends with revenue seasonality, in that their revenue can be affected by factors such as subscriber behavior during specific seasons, scheduling of major sporting events, or cancellations and postponements of events. The company experiences higher revenue and subscriber additions in the third and fourth quarters due to sports leagues like NFL and college football. Advertising sales also tend to increase during the fourth quarter with the holiday season. However, this seasonal impact on revenue can lead to potential shortfalls if certain conditions occur, such as macroeconomic factors or increased competition. As a result, accurate forecasting is crucial for FUBO's operations. Other factors to consider relate to long-term content commitments. They often enter into multi-year agreements with content providers, limiting their flexibility in response to changes in the market or business. If they fail to meet subscriber acquisition and retention expectations, their margins may be affected. Moreover, upfront cash payments for producing content could strain liquidity if revenue growth doesn't match expectations. The long-term nature of these commitments also hinders quick adjustments to their content offering if it fails to perform well in a specific territory. Along the same lines, FUBO's results may be negatively impacted if they are unable to renew long-term content contracts on favorable terms. These contracts cover both the acquisition and distribution of media content, including sports events and other programs. If these contracts expire without acceptable renewal terms, FUBO risks losing content rights or distribution rights. And even if the contracts are renewed, the cost of obtaining content rights may increase. Factors such as advertising markets, subscription levels, marketing efforts, and viewer audiences can affect the impact of these long-term contracts on their results over time. That's why maintaining relationships with content providers remains crucial for retaining existing subscribers and attracting new ones. The company has invested time into cultivating these relationships, but acknowledges that they may not always result in financial gains. They must consistently meet customer demand for popular streaming channels and content, especially as they expand into international markets. There are also potential risks to FUBO's business if they fail to attract and retain subscribers due to competition or changes in content distribution strategies. Factors such as pricing, service levels, customer satisfaction, and the availability of compelling content are all important for maintaining subscriber growth. In addition, factors like shifts in content provider strategies, exclusive partnerships with other platforms, and increased competition from major players could impact FUBO's ability to retain existing subscribers and attract new ones. In some cases, certain agreements with distribution partners contain parity obligations that require FUBO to offer the same technical features, content, pricing, and packages to all its distribution partners. These obligations can limit their ability to innovate or pursue unique partnerships. FUBO goes on to explain that delays in technical developments across partners may put them at risk of breaching parity obligations, threatening the certainty of agreements with these partners. In regards to advertising, it is vital to maintain an adequate supply of ad inventory on their platform for FUBO's business growth. The company depends on growing video ad inventory by adding and retaining content providers with ad-supported channels. Failure in achieving this goal could lead to a decline in their business as they compete with other internet streaming platforms and traditional media for advertising revenue. They admit competitors are often larger and better equipped, which can affect their ability to attract advertisers and generate revenue. To counter these challenges, FUBO plans to improve its platform's data capabilities, expand advertising inventory, and enhance their advertising sales team and programmatic capabilities. In the past, it has also been noted that several major content partners impose significant restrictions on how the company can distribute and market its products and services. These restrictions may limit the ability to respond dynamically to changing customer expectations or market demands and hinder exploitation of partnership opportunities. Furthermore, certain provisions in these agreements might become challenging to comply with if key programming rights are lost. What's more, content providers' rights granted to the company are complex and multi-layered, substantially differing across different content types and providers. Compliance with these restrictions is costly and challenging, while any failure may lead to breaching agreements and subsequent loss of content and damages claims. One example of such complexities and restrictions involved FUBO losing access to local news and weather programming for thousands of Spanish-speaking consumers in the U.S. due to TelevisaUnivision pulling their content from the platform. The reason cited was a refusal by TelevisaUnivision to offer fair and competitive rates for the renewal of their content agreement. FUBO attempted to negotiate with TelevisaUnivision, but they demanded an increase in prices by 25% for subscribers. This would result in higher costs for users to receive vital local news, weather, sports, and entertainment programming in Spanish. Then, when FUBO is a producer and distributor of content, there can be unforeseen costs, potential liability for negligence, copyright and trademark infringement, and other claims based on the nature and content of materials they acquire, produce, license, or distribute. The development and expansion of original programming have introduced new production-related risks and additional expenses. Negotiations and renewals related to entertainment industry collective bargaining agreements could also impact timing and costs associated with their productions. Furthermore, FUBO may face potential liability or suffer significant losses from third-party arrangements, as well as product liability and intellectual property claims related to merchandise sales. To mitigate these risks, FUBO may decide to remove content from their service, not place licensed or produced content on it, or discontinue or alter production of original content if it could negatively impact their brand or business. When it comes to cross-device availability, FUBO relies on partnerships to make its streaming service available on various internet-connected screens like TVs, digital video players, and mobile devices. If these partners terminate their carriage of FUBO service, or if technological, content licensing, regulatory, or business issues arise, it may hinder FUBO's ability to retain subscribers and grow the business. And although less likely at this point, there's also risk if partners do not continue providing access on acceptable terms or if technology changes lead to updates or discontinuation of support for certain devices, impacting user experience and satisfaction. Speaking of partnerships and reliance, the company relies on Google Cloud Platform, GCP, and Amazon Web Services, AWS, for certain aspects of their service. Any disruption or interference with their use of GCP and/or AWS would negatively impact their operations and potentially harm their business. The company runs most of their computing on GCP, but some key components are on AWS. They mentioned that they cannot easily switch providers and acknowledge the competitive threat from Google through YouTube TV and Amazon through Amazon Prime, which could further harm their business if these companies utilize GCP or AWS to gain a competitive advantage against them. Similarly, there are potential issues associated with relying on third-party providers for geolocation and identity verification systems. There's no guarantee that these providers will perform adequately or provide accurate information. Inaccurate data from these providers might also result in unauthorized access to their offerings or denying access to those who should have access. The provider of geolocation services depends on obtaining necessary information from various sources, which may be subject to disruptions or failures. Losing these contracts or failing to find equivalent third-party replacements could lead to operational issues and potential legal problems. Now, although FUBO and the industry at large have benefited from the so-called cord-cutting movement away from traditional TV providers, some may argue the market has become too saturated and that the growth of TV streaming as an entertainment alternative could slow down. Due to factors such as the availability and cost-effectiveness of broadband internet service, quality of content delivery, emerging devices and technology, and a desire by viewers to have more simplified and consolidated options. There is also competition from traditional advertising platforms that could have some influence in shaping the industry's future growth. It is also worth mentioning piracy-based offerings pose a significant threat to the company's success due to their compelling proposition to consumers, especially during times when paid streaming loses its appeal and value proposition for viewers. Then, some specific concerns for FUBO relate to its previous involvement in sports wagering that subjected it to various gaming laws that are still developing and could lead to claims or harm its business. The violation of these laws, or changes in their interpretation, could be detrimental. Even though FUBO Gaming dissolved FUBO Sportsbook, they had launched it in Iowa, Arizona, and New Jersey. Entering the sports wagering market exposes the company to different laws and regulations from one jurisdiction to another. Future legislative actions, court decisions, or other governmental actions may have a significant negative consequences that have yet to be seen. The risk of civil and criminal proceedings against the company could result in penalties, fines, asset seizure, or restrictions being imposed. In the not-too-distant future, we should see how the market responds to all these concerns weighted against the company's growth strategy and business model, along with the recent catalyst from the merger with Hulu Plus Live TV. For more on FUBO and other companies, follow Ascencore. Thanks for watching and have a nice day.